Hello, you guys. Welcome to Smart Investing. Today is August 20th, Saturday, 12:39 a.m. I'm on the East Coast in Florida. Markets are closed, and the markets went down today. So, for this video is going to be about the banking sector. So, I have the next 5 stocks for you. These are the 5 stocks that I'm going to be going over. And for this video, we are going to be going over fundamentals, technicals, and a little bit of the quants. And when I start the video, again, I'm going to be doing, I'm going to start from the bottom and work my way up like that. So for the first stock that I have is FNWB. It is First Northwest. And we're going to take a look at this stock. So first thing I see that comes up, market cap, really small market cap. Earnings per share. So again, personally, I'm not too crazy about that. 52-week high, 52-week low. It's only like about a $10 difference. I'm kind of neutral about it. So I don't know what to say. PE is at 10.75. That's a cheap value. Earnings per share is at 1.53. Dividend is at 0.28. Volume is really low. So we're going to look at the 5-year real quick. And it looks like they're pretty undervalued. So for the 5-year, as of right now, they're barely hitting the target. And I would say they are at a very good value. But again, this is a company that pays dividends. So there are better companies to invest in if you want to have more total return for the dividend payments. So we're looking at the technicals. So that, and let me just point this out. So I wish I can zoom in. Let me open this up a little more. Okay, so there we go. Hopefully that'll help you guys out. So okay, my board looks totally different. Oh, okay, this is new. Sorry, I'm just sort of experimenting. This is much better actually. So I have a circle. Cool. Cool. Okay. Have that. Screenshot. I'm gonna get rid of that screenshot, but this is gonna help me more for the videos. Let's change it to, I don't have a lot of red here, but let's do, let me see. I don't know what color you guys like. Let's start off from left to right. Let's start off with gray. Just because I haven't done that color. So as we can see here, we have okay, so as we can see here that we're using, sorry, you can see here that I'm using the 20 EMA, 50 EMA, and the 200 EMA. And this is on a 5-year chart. As we can see here, as of right here, I don't know what's going on. Why isn't this not working? Bear with me, you guys. For some reason, I don't know. Let's just draw the line. So anyhow, as we can see here, I'm using the $50 EMA right here, and then you have the 200, using the 200 EMA. So between those points, I'm using that as support and resistance. Support is on the bottom, resistance is on top. So what I'm doing is basically, let me widen this up real quick. So basically, that's the range that I'm going to be looking at. So basically from $18 to $16, because that's the information that is being provided to me. And again, it's because if we continue this line, and then obviously this line is going down, again, as of right now, that box is there, but as this line goes down, this box is going to get smaller. But again, that's the range that I'm looking at. And again, it's still just by the PE, it looks pretty cheap. So if it gets even cheaper, even better. And then now we're just going to look at the quants real quick. The reason I'm using a 5-year is because, let me go back. So we're going to look at the Dow Jones, S&P 500, and the NASDAQ. So as we can see, throughout history, all the way from the 80s and the 90s and then far back from that, as we can see from that, we have here you have here, look at these slight dips and these slight jumps. So, if you look at this on a long time frame from years and years and years, I'm sure there have been steeper drops, but as time goes on, they just get even smaller and smaller and smaller. So what I'm saying is, if you compare all these little drops and these jumps, they're nothing compared to the last 5 years. And what I'm saying is, if these numbers on the bottom were not here, and I asked somebody randomly, what do you think of this chart? I would ask somebody, what time frame would you think starting from about right here. What time frame do you think that is? Because look how big this jump is. And then yes, even though it's flat here, you see this next big jump. So what I'm saying is this one is bigger than the one before it. So you have this one and this one. So actually, this one here is the bigger one than this one. So what I'm saying is, these are just this jump alone, just that jump alone, you can't really find a jump that high because it took so long of a time frame, meaning years. It took so long in time for it to get to that high. But by the angle and by how high it is, the height of it, that's what makes it so dangerous, because in order for it to go that high, it would have to go fast in a short amount of time. So essentially what I'm saying is, the faster and higher it goes, the more dangerous that is. So if we look around this time frame, this is going to point to around 2016 actually. So this is why at least I get the last 5 years. If I wanted it, I wouldn't say if I wanted to, but if I had the choice to, if I had a choice to do it, I would definitely get 2017. Because as we can see here, the end of 2016, and even though 2016 had some dips, the end of 2016, and you can kind of say the start of 2017, that was the start of a huge bull market. And then from here to here, this period, as you can see here, so you have from around 2017 all the way to 2018. That was just insane. That was just an insane amount of growth, apparently. So now, if we go here, this looks kind of flat, right? So then around this time in 2019, it broke up, which is fine. Then in 2020, it dropped down. But guess what? This little drop here dropped so fast that, it decided to go up even faster and even longer in height. So that's why we have what we have now. So what I'm saying is, this was a big trend. And then, yes, it was sort of flat. It was actually higher than that within the years, because I've seen it. But even though we had this drop in 2020, this was only 2 months of a drop. And then it supposedly rebounded. So in 2 months, you already gained your money back. So after that, you have this huge spike, which was another spike. And then you have this slow downtrend. But again, we have another huge spike that's gone up again. And then what you can see here is that in time, a lot of people use the 200 moving average. There's different variations of moving averages. It's just a matter of preference, really. And then a few of them do contain better accuracy. I like to use the EMA because it's more accurate and it smooths out the lines and stuff. So as we can see here, you can definitely see below this, my dark line is the 200. Then the lighter, the regular blue is the 50 EMA, and then the lightest blue is the 20. So you can actually say the regular blue line, I like to use that as resistance, and then the 200 as support. If it goes below this, that's a very strong trend. That's like a major trend. If we use the 50, you can actually use that as resistance, and even though it's slightly above 50, if it slightly goes even below 50, that's still somewhat of a good opportunity, but not the best opportunity. And as we can see here, you have a bunch of times where it has, let's look at the 2001. You can see here it's gone below the 200 EMA, and all this time from 2002 all the way to like 2003, it was below the 200 EMA. And then finally it got bounced back, and then it has stayed over the 200 EMA. And then fast forward all the way to where we're at, and that was in the 2008 crash. And then barely here, it just touched it, but it went right back up again. That would have been a nice opportunity to look at some stocks. But again, for the overall market, again here in 2020, I was waiting for stocks to go even lower than this, because this wasn't really a recession. A 2 month is not really a recession. It could have gone 50%, but 2 months is like nothing. I don't really count that. Now for this one, it's barely touching the 200, and we're supposed to be in a bear market. But again, look how fast and look how high this jump is. Touched down to the 200, went up to the 50, and it's flirting with the 50. So that's a major resistance level, and we're gonna see what happens in the next few weeks. So I just want to get that out there. So anyhow, the other two charts are the same thing. So you can see under the 200 EMA for the S&P 500. And again, this has not gone below the 200 EMA, so we still have a lot to go down to really consider that a bear market, a strong bear market. I think if it dips below this, it's gonna be for, I'd say, at least a year. It's not gonna be a few months for the bear market, which supposedly it has been for this year, since the start of the year, and it has gone down. But apparently the government wants to say we're not in a recession when supposedly we are. See, now when we look at the NASDAQ, this jump doesn't look that much because this chart has more steeper declines. But if we look at the S&P, it's closer to actually getting to its new highs again. Again, that's just because a bunch of sectors that are in both of these market indexes, that doesn't complete the majority. The majority of the stocks, the ones that actually determine the winning streak and the losing streaks for the overall markets, it's the NASDAQ, because those are the technology stocks. And there's about 50% of the technology stocks which determine close to the NASDAQ. So basically, if the NASDAQ goes down, all three of those indexes go down. That's what usually happens. So the Nasdaq is the most important one. So, anyways, now you guys know and see why I have that, and that is why I'm using those technicals. As we can see here, about 5,000 stocks for the day, and 1,000 were positive. So obviously more negatives than positives. And then we're gonna look at the stocks here. So I had FNWB. So now we're gonna move on to the analysis real quick, and we're gonna fast forward here. So for the rating, for the quants, we have momentum at 9.32, and coming in second place is a value. I can agree with this. For this rating, I think it should be lower. The growth, I'm not too sure about it. Quality, not too sure about it. Momentum, the reason I say momentum should be lower, and I just don't believe in it. I mean, it looks flat from here. Yes, it's below the 200 and it's a good value, but it seems pretty flat. The volume is pretty low, meaning not a lot of people are buying or selling this stock. And yes, even though it's a cheap stock by price, you look at the market cap, it's not a strong company. So right away off the bat, market cap can tell you a lot. I don't think this stock would do good in a recession. That's just my opinion. Market cap just doesn't hold it. I hope I'm wrong, but we'll just look at the fundamentals real quick. So we have here, see if they give us annual results. It's taking a little while, but I don't know why. So maybe it's a little slow. So anyways, we have annual results. And okay, net income is up. Revenue is not giving me. So we're gonna look at the balance sheet. I just don't like banks. Banks are just awful. As you can see here, they are 90% debt. That's not something to be proud of. So yeah, there's better ways. And then the dividend is at 7 cents. 6 cents last year. You can see 6 cents starting from 2020, and then 2021 we have 6 cents and 7 cents at the end of the year. I mean, these are just low numbers. I'm not even gonna bother with them. It's just not even worth it. Why spend your money on trash when you could just find something else? This is a big no for this stock. There's a lot of no's for me to add this to a watch list. So my answer is no. Next up is TMP. So we have TMP. We look at the last 5 years. Honestly, you see the 200 moving average. It looks flat. That's all I can say. It looks flat. I haven't seen uptrends, and then all of a sudden 2022 is starting to go down, starting to follow the major market, which would be, the major index, which would be either the Nasdaq, S&P, or the Dow Jones. Volume, that is pretty fair to see as a volume. So there is some slight interest into this stock. Market cap is at 1.13, so it's a $1 billion company. Slightly undervalued. So it's telling me It has a decent value. 52-week high and 52-week low. That's very respectable for 52-week high and 52-week low. Uh, Dividend is at 2.2. That's definitely not bad, but I just prefer a different stock when it comes to financials or other companies and stocks that work similar to a bank and that they are better than the banks. So, looking at the chart, again, it looks flat. I don't like the chart. I'm not crazy about it. It needs to break out some more. There's a lot of wild swings here. There's a lot of wild jumps and movements. I'm not too crazy about that. We're gonna look at the analysis. Let's see what we have. So we have quant ratings. So income, they rated at 4.5. Overall rating is a 5.17. The strongest quant rating that they listed is quality. I could be wrong. There might be something I don't know about this company. Maybe it says if they're quality, the okay, that was a screenshot that I had from earlier. So when I think of quality, I think of a good balance sheet, and I think of, I mean, what was the rating again? So obviously, it's not like a rank 9 or a 10, but if you round it off, it'll give it a 7. But definitely the number one factor, if I hear for a decent balance sheet or a decent quality stock, they have to have lower debt than their peers or really low debt or manage their money very, very well, even in stressful environments. Um, Net margins is definitely a plus because the banks, they're always in debt. They're always using like high debt. I just don't like companies that do that. I don't know how they survive or manage to do that. So we're gonna see what they're about. It's not really loading for me. Everything is pretty slow. I don't know what's going on, but it's not giving me any info for indicators, and then the income statement. I'm pretty sure it's the same thing. They're not gonna give me. See, they're not giving me any info. So Webull still hasn't fixed this. Uh, Balance sheet. I'm not surprised. Over 90%. There has to be something good about this company. Really, really good. Either they're hoarding cash or something. Uh, so operating is at 121 million. So definitely it's not their cash flow because it looks like they're in the negative. And their debt is high. So I'm actually gonna disagree with that rating. And the only thing good to say for the decency, 52-week high and low is respectable. Earnings per share is pretty respectable, and they are undervalued. Um, Overall, again, I'm gonna say no, just because of the balance sheet and everything going on and whatever. Um, I think the only reason they gave it such a high rating for the value is because if you compare how much dividend they pay, just one dividend payment alone is more than a payment for the whole year than most banks, because most banks are just cheap. So off the bat, this company is at least paying 50 cents per quarter, So you're at least getting, $2 a year, or basically $2 in total payments for one share of this company for one stock. And obviously they're doing the rising dividends. So again, let's see and read about what this company is. But again, I'm not crazy about it. I think there's better uh, companies and stocks that do similar services and does similar work as banks, but they're not quite licensed as a bank, or they're not quite um, insured as a bank and stuff. So they're just better stocks than banks when it comes to the financial sector. So again, I'm gonna say no to this one. SAL, Salisbury Bancorp. We have that. This one looks better. I like this chart. So you see here, 2021 it went up, and this one looks actually much better than the last one right away. So 52-week high and low. So market cap needs work, but I'm sure their margins are low, and everything is low, and they have a chance. See, that's what's good about having a low market cap, but then it sucks because you're not strong enough to take a hit when things are going bad. But um, any little mistake you make when it comes to either spending or saving is just crucial because of how small a company is. So every dollar that goes out, they just have to, maintain and have better money management skills, especially than their peers. To, um, I think a company shouldn't worry about, outperforming the S&P, outperforming their peers. Um, what new companies and what you want to see what new companies are doing, you want to always see them have positive earnings. It doesn't have to be over a certain number. It doesn't have to be over one or whatever. They just have to maintain positive earnings. Once they have negative earnings, um, it's people like me. Yes, I'm a retail investor, but institutions do pay attention to that. A lot of people need to remind themselves that negative earnings are not good to see. And it's understandable during high stress situations, but uh, during decent times, yeah, you should not have negative earnings. And the reason I say this is because big institutions see that, and the majority of them, they just don't like it. It just doesn't make any sense. You cannot run a company just based on debt. You have to have like equity or some kind of savings, or um, you have to have money ready, willing, and available somewhere, somehow, um, in any way, shape, or form, because the business won't survive uh, just on debt. So that's just the way things are, unless you're a bank, and that's it. That's the only way. But yeah, usually that's how it goes. So we have here. So again, like I said, for the last company, they paid a 56-cent dividend, and now this company had a dividend cut. As we can see here, they're doing good, 32 cents, and then all the way down here, like, past years, they did it. But now it's like that had a dividend cut, and they had a split. Oh, that's not good. And let me see something else. Let's see. So they are giving me annual estimates. So, wow, return on equity has improved. Earnings per share, margins are not showing me. 91%. Not crazy about it. So again, I'm not getting revenue. Like, I'm not getting information that I need. We're gonna look at the analysis real quick. So they gave this a 4 for quality, but then the highest rating was 6.79, and that was for value. So basically, the price for this stock, uh, they're saying is pretty decent. It's okay. Share price is okay. Slightly cheap. Uh, but I'm gonna say no. I'm gonna say no. They cut that dividend and they did a split, so I think that's what ruined it a lot. So next up is ROI, Royal Bank of Canada. I've heard of this bank. They're supposedly really, really good. One of the best banks, actually. I'd say in the top uh, 50 or top 100 at least. 52-week high and low. So as you can see here, monstrous number for the market cap. That is definitely a positive sign. You see volume, it's exactly what I'm saying. A stronger market cap increases the interest and staying power on the market. So you can see here that volume was close to 500,000. So this is an active stock because, you know, the company can hold up well. So we have a 52-week high and low. So a 52-week low rounded off to 90, 52-week high close to 120. So that's like a $40 difference. PE slightly undervalued as of right now. Dividend yield is 4%. And as you can see here, total dividend payment 3.985, close to a 4. So as we can see here, their earnings definitely support it. Earnings are close to a 9. Definitely outnumbers the dividend total payment. So as we can see here, definitely nice chart. It's only gone slightly down, but again, it hasn't hit rock bottom back to its 2020 highs or previous levels close to it. So as we can see, the chart looks good. So 1 out of 3 is good. Now we're gonna see the quants. See if I agree with it. Uh, the income, I'm not gonna say I love it or I like it, but I'll say this. I'm just gonna state the fact that it's better than most banks. The quality, I can agree with that number. Um, the value, I think it's actually a little bit more. I would say a little bit over a 6. I would say it's above a 6. And then the growth, I'm going to say a slightly lower. And now we're going to look at the fundamentals. So, for the majority, I mean, for the quant ratings, I somewhat agree. You know, half and half. I do agree on some of it, and I don't. But if I had to say yes or no, I would say yes for the slight advantage. Yes, just because I like the market cap, and I'm sure that they're outnumbering. Just with the market cap alone, I'm sure their numbers are just enormous compared to other companies. So I mean, it pays to be the big shark or the big whale in the sea, you know, because if other banks are doing bad, they might even acquire them out of nowhere on such short notice. But again, just with the market cap alone, that's just like, you know, the whale walking in the room, you know. or as they say, the elephant in the room. It's definitely an elephant. So we're looking at the fundamentals. They carry slightly more debt than their peers. Um, Frankly, to the point, for me, honestly, I wouldn't invest in the company. I don't like it. Again, just because it's a bank, way too risky. And then the debt is actually higher and higher year by year. Um, that kind of scares me. Seeing that from a company because um, the last thing you want to do is keep adding debt, and then you don't know if people are gonna pay that debt for you. Um, it's just way too risky. I understand taking high risks, but there can be a point where you need to do a resting period, and it this doesn't look like it. Um, yeah, that's close to 95% debt. So yeah, I see that, the balance sheet. I don't know if this is correct, but 1.71 trillion. I don't see that happening, especially with the amount of debt. I would be surprised if they had positive cash flow. So they do not have positive cash flow, and that's pretty much it. So overall, I'm gonna say no to this company. Um, I mean, it's hard to say. I said no, but I mean, honestly, it's hard to say. Um, Me personally, I'm gonna say no. Somebody else looking at this, they might say, "What the hell?" Not even care. Um, Let me just go over it again. So for the price that I'm looking at, let me look at the chart again. So for the price, um, I still think so. It's above the 50. It's more on the higher end. It should drop down a little more. It could drop a few more bucks. If it could drop up to at least uh at least 10 more bucks. I say 10 to 15 more bucks. Now we're talking. Uh so again, 52-week high and 52-week low. That checks out. PE checks out. This checks out. But what doesn't check out is the balance sheet and the fundamentals. The quant ratings, again, I sort of agree with it, but definitely no. I don't agree with the momentum. Yeah, they might have close to half a mil in stock trades for, you know, on Friday. And maybe for the whole week, they're pretty active. I'm sure this is an active stock anyway, but it's just not worth it. So last one up is FCCO. So we have looking pretty flat. I'm not too crazy about it right off the bat. I'm gonna say no. 52-week high and low. Not even above $10. Pretty undervalued. So saying that you could get at a good value. Earnings per share is at 2. Dividend is at 0.52. So they can afford the dividend. Now we're gonna jump right to the quant ratings. Um, Let me look at the numbers up top again. So not so much momentum. The value, yeah. So I guess I can agree with this rating, close to a 5. They rated it above a 5. So we have here, where's their debt at 92? So it went up. Yep, it went up from previous quarters. And again, I don't have all the information that I need to evaluate it because the app is acting up. So as you can see here, slightly went up on debt. It went from 89% to 91. 2% doesn't seem like a lot, but over time that can be a huge burden. So now we're just gonna look at the total dividend payments. I don't like the total dividend payments. The amounts are really, really low and not to my liking. Uh, I'm gonna suggest that people should not follow this blindly. Just because you see a cheap price doesn't mean that it's good. Please do your homework when you are investing in the stock market. So apparently I thought this stock had a chance. So I'm going to say no to all of these stocks. So there we have it. I'm going to say no to all of them. So thank you guys for watching. I'll see you guys in the next one.